When retirement finally arrives, many people expect relief, yet often they face new challenges. Taxes can erode savings in ways they never imagined. But those who plan with wisdom find that retirement can truly be a stage of stability, service, and satisfaction. One key principle is recognizing that money is not only about personal comfort, but also about responsibility. By managing income in lawful and thoughtful ways, you ensure that what you keep is pure, and what you spend brings true peace of mind. Consider the journey of Daniel, a teacher from Texas. After 3 decades in the classroom, he had saved through his pension and a 403b plan. Initially, he withdrew without strategy, only to realize that his Social Security was becoming taxable, and his healthcare premiums were rising. The stress surprised him. Then he discovered a different approach, using taxable savings for everyday expenses while delaying withdrawals from his retirement plan. By shifting to Roth conversions during lower income years, he eventually lowered his future tax burden. Daniel's story shows that even after retirement begins, it's not too late to adjust. Many retirees underestimate the impact of inflation combined with taxation. What feels like enough today may feel strained 10 years from now. A balanced approach often involves not only tax savings, but also steady growth. Low-risk investments that generate favorable tax treatments such as municipal bonds or long-term capital gains help maintain purchasing power while minimizing the IRS share. Retirees who understand this connection find themselves more prepared for rising costs of food, energy, and housing. Powerful yet often overlooked strategy in retirement is the timing of charitable giving rather than writing checks from a regular bank account. Many retirees choose to donate directly from their IRAs once they reach the eligible age. These qualified charitable distributions count toward required minimum distributions, but do not add to taxable income. This method allows retirees to support meaningful causes while also protecting their own finances. For people of faith, it brings reassurance that their giving remains both sincere and financially wise, showing how personal values and financial planning can align. Another key principle is the order in which accounts are used, often called the withdrawal sequence. Beginning with taxable savings gives retirement accounts more time to grow. Transitioning later to traditional accounts before claiming Social Security can create low income years that are ideal for Roth conversions. Finally, using Roth savings in later years provides tax-free funds at a time when healthcare costs are often rising. While this sequence is not identical for everyone, when structured carefully, it can significantly extend financial security compared to unplanned withdrawals. Consider to retirees Robert and Alan. Both had similar savings, but Robert withdrew in no particular order, paying heavy taxes some years and higher healthcare premiums as a result. Alan, however, followed a deliberate sequence: taxable savings first, measured IRA withdrawals next, and Roth accounts later. 2 decades into retirement, Alan still had strong reserves, while Robert's funds were nearly gone. The difference was not chance, it was the discipline of strategy. Geography remains a powerful tool. Moving to a tax-friendly state, or even relocating within the same state, can have long-term effects. Some retirees discover that a neighboring county offers lower property taxes, or that certain states exempt Social Security completely. By aligning location with lifestyle, retirees save money without sacrifice. Relocation is not always easy, but for those open to it, the rewards are significant. Healthcare savings accounts also deserve attention. For those who contributed during working years, HSA letters provide triple benefits: tax-free contributions, growth, and withdrawals if used for qualified expenses. In retirement, healthcare becomes one of the largest costs, so an HSA essentially serves as a hidden treasure. Retirees who preserve their HSA for decades often find themselves with a financial cushion that pays medical bills without adding to taxable income. Stories of regret often highlight what happens when these tools are ignored. One retiree, David, lived comfortably but never planned for taxes each year. He withdrew more than necessary, causing his Medicare premiums to spike. Later, when his health declined, he had fewer resources. In contrast, his neighbor Mark used careful planning, kept withdrawals modest, and leaned on Roth savings. Even as his medical needs grew, His finances remained strong. Both had similar careers, but one planned with knowledge, the other without. The larger lesson is that retirement planning in the United States is less about beating the system and more about understanding it. The tax code provides legal opportunities to keep more of your money, but only if you take the time to learn. Those who remain unaware often pay more than required, not because they must, but because they did not prepare. One of the most powerful steps is starting early. Younger workers may think retirement is far away, but the earlier you contribute to Roth accounts, the more you secure future tax-free income. Compounding grows quietly in the background, and when retirement comes, the benefit is enormous. Even modest contributions in your 20s or 30s can create decades of tax-free growth. For those who miss that window, conversion strategies later in life can still bring meaningful relief. For couples, coordination is essential. If one husband has higher earnings or larger retirement accounts, shifting assets strategically can equalize taxes. Filing jointly often provides benefits, but with careful timing. Couples can even take advantage of different tax brackets. Communication between spouses about withdrawals, giving, and spending ensures that both remain secure. Even if one partner pauses earlier, many widowers find themselves paying higher taxes after losing a spouse, but proper planning cushions that transition. Psychology also plays a role. Many retirees fear spending, holding onto savings so tightly that they fail to enjoy life. Ironically, this sometimes leads to leaving larger taxable estates than necessary. By intentionally balancing withdrawals, giving, and spending, retirees can both enjoy their wealth and reduce taxes. It is not about extravagance, but about living fully without unnecessary fear. Faith reminds us that money is a trust. Managing it with honesty, avoiding waste, and seeking lawful benefits is part of fulfilling responsibility. Retirees who align their finances with these values find that their wealth becomes not just numbers on a page, but a source of genuine contentment. They use what they need, they share with others, and they prepare wisely for the years ahead. Imagine a retiree at 75, sitting on his porch, realizing that his finances are secure because of the choices he made earlier. He is not worried about the IRS, not burdened by unexpected bills, and free to focus on family, community, and faith. That sense of peace is priceless. It is the real goal of retirement, beyond money itself. The American system allows this, but it requires effort. Knowledge, patience, and discipline turn potential stress into lasting security. For every retiree who struggles, there is another who thrives, often with the same amount of money, because they applied these strategies. Retirement does not need to be a burden. With halo choices, careful planning, and mindful living, it becomes a time of dignity and blessing.